way, in the long run, you're better off investigating at least whether you should start there.
Yeah.
Because you talk to a bankruptcy lawyer, you don't have to file bankruptcy, but you can find out what the time process is, how long it takes to do, what does it cover, do I qualify? And if it turns out that's a better way for you to go, then when you go through the process, you don't have these issues of debt or lenders hounding you for payment, and you don't have income tax consequences from the process.
Uh-huh.
Now, another thing that you can do, if you find yourself in the situation where it happened, the property's gone, and now you owe money,
Yes.
then the other opportunity that you have is if you are insolvent, and that's a matter of, it's not just a word, there's actually a process to figure that out. It's a calculation, and there are forms with the IRS. And so you can have an actual tax liability and go through the insolvency application process, and to the extent you can prove insolvency, you can also eliminate or reduce your tax liability.
So
And that's where somebody like accountants are very useful.
Right, because there are people who say, how do I apply for insolvency? And it's not an application, it's something that you demonstrate.
Right.
And so related to this, I believe there's an IRS publication, I think it's 4681, that relates to debt cancellation, and also covers foreclosure and so forth, some of these things that we're actually talking about today. They have worksheets and other things in there to help in this process.
It's fairly complicated reading, but I would also say for people who are willing to take it on, it's worth looking at that kind of publication and reading through it, and then informing yourself. You'll probably have more questions than answers, but at least you'll know what the questions are to ask.
Maybe give you a starting point for working with a professional. Now, also related to this, so we talk about like some hidden assets. For example, people think, well, I know I'm insolvent, here's my assets and here's my liabilities, but they may be excluding something on the list. And a very common one, for example, is retirement accounts.
Mm-hmm.
So you may have a big IRA because you have maybe a rollover from leaving an employer or something like that, or you may have one of the simplified employee pension plans, a SEP account, or you may even just have a pension account, a 401k account with your employer. These all count.
Right. Everything. With the IRS, everything counts.
Everything counts. So you may think that you're insolvent, but when you add those things on top of the list.
And another thing, I do estate planning, as you know, and another thing you have to at least think about are expectancies. I've seen a situation where someone was in the middle of a bankruptcy, and they were going to be benefited from the bankruptcy, but had a very ill parent, and the parent died in the process of the bankruptcy.
Ouch.
And the inheritance came, a large inheritance, and everything got paid off. All the creditors got paid off. The bankruptcy court everybody got paid, and it was all out of the inheritance. So you need to be at least thought. There's no way to really control that, but it's something to consider.
Yeah, it's just to be aware of.
Right.
And again, on the list of assets, well, if grandma's estate is being administered,
right,
and you've got this thing going on,
right,
and but it may be 6 months before grandma's estate is in fact distributed, it doesn't matter. In a sense, that is an asset.
Right, it is.
And so, so you may need to think about that. Another thing related to this is record keeping is a really important piece of this puzzle, and some people are awfully careless about their record keeping. And so, for example, I had one of these couples come in who had, unfortunately, they had some foreclosures and short sales that they were involved with. And so we were trying to use the insolvency exception for them. They, I said, we need to put together a list of your liabilities. Do you have your credit card statements from the time that this was going on? Credit card statements? No, we always throw those away. Well, how about your bank statements so that we can show what the balance was in your bank account at this time? Oh no, we don't hold on to those things either.
Right.
So
and then they find out the banks don't hold on to them either.
Well, so some of them you can get online, but once you go out beyond a few months,
right,
then these can be pretty hard to get a hold of. And then if you have a situation that, it's 16 months later because now you're preparing your income tax return, which is on extension from last year. So now you're filing on October 15th for last year's transaction that happened in February, say October 15th of 2010. We're talking about February of 2009. And now you're trying to go back to get these things. You may find it's really, really difficult.
Well, I think it's really important that anything involving your residence, your home, to have complete records as you can. Because even if people have the idea that you don't keep things for more than 7 years, but sometimes you need to prove something that has to do with the purchase of the property, for example, that goes beyond that. So there are certain things I would keep.
Well, now we have carryover basis maybe for this year.
Well, at least for now we do. So the other thing I would like to just emphasize is that there are multiple states.
Yes.
Not all of them have anti-deficiency statutes, but the ones that do, 3 of them nearby, California, Nevada, and Arizona.
Yes.
Nevada didn't have an anti-deficiency statute until October of last year, so it only applies to new purchase money mortgages for personal residences. And that's essentially what they all apply to, purchase money for personal residences. But the wording varies, the amounts vary, the sizes of the property vary, all the definitions vary. So you really have to know, depending on where you own the property, what the law is. And so you can't assume that what's true in California is going to be true in another state just because it has an anti-deficiency statute.
Right.
So, and a lot of people make that mistake. They think the rules that apply here will be the same in a place like Arizona, and it's not true.
And it may be a good idea then to actually consult with an attorney for the area that your property is, or the state that your property is in anyway.
And the other thing is, a lot of these issues are in flux, meaning the laws are changing, and laws are added, laws are taken away. In Arizona, for example, they had an anti-deficiency statute that actually is in many ways more liberal than in California, and they repealed it. And then it was only repealed for a short time, and they realized that that was going to create all kinds of havoc, and they reinstated it. But I mean, it's like a month by month issue where you have to check sometimes.
What was the law at the time when this one happened?
What's the law today?
Oh my gosh. Okay. Okay. Well, we just have a little bit of time left. Do you have maybe some final thoughts related to this area of taxation and these?
Well, as I said in the earlier program, I think it's really critically important for people to get really good information. And I deal with this quite a lot. I've had a lot of people come to my office. I know you've had people come to your office. And what I've found is that until you know all of the facts of their case, you really cannot tell them what the answer is, because a very small fact will sometimes change the outcome from a tax situation, but also from the standpoint of how the transaction is going to happen.
Yes.
And so it's really important not to believe what your friend tells you, not to believe what you read on the internet, because the information might be true, it might not be true, and it may apply to you, it may not apply to you. And so there's not a broad brush that you can paint over these things. The facts really do make a difference. And there isn't one right answer for any one person, or I mean for all people. There is a right answer for one person, but not for everybody. So, it's important to learn as much about this as you can so you can be conversant about it, but how the issues apply to a particular client is going to depend entirely on the facts.
Okay. Bill, I want to thank you so
Pleasure.
much for joining me and talking in a couple sessions about short sales and foreclosures. So many people are wrestling with these areas, and so they really need to get some good information to get started in conversations with their advisors. And folks, it's worth the investment to get some good advice. So, if you are dealing with this or you have a friend or relation, good luck to you all. And we'll see you next time on Financial Insider Weekly.